Okay, we are starting this very quick revision of decision-making section. In decision-making, we have several techniques. For example, we have one thing which is called CVP analysis. CVP analysis could be for single product, and it could be for multi-product as well. So actually, previously single product was in F2, multi-product was in F5. Now they have put both in F5. So CVP analysis, this is actually where you do your break-even analysis. Okay. So this is one area in decision making. The second area in decision making is limiting factor analysis. And again, in limiting factor, you have, single limiting factor and multiple limiting factors. Okay. And here, how to say, the idea is to find out your profit maximization. Profit maximization, and I would more correctly say it, contribution maximization. Remember that when you do decision making, we start with short-term decision making. We call it short-term decision making. Okay, short-term decision making. Like when you say that, oh, I want to do break even. So break even is not a desirable situation. When you say break even means no profit, no loss. So you are talking about break even in the short period. In the long run, of course, you want to make profits. So the CVP analysis is actually short-term decision making. It is not long-term. Similarly, when you do limiting factor analysis, in limiting factor analysis, the idea is we say that the resources which are available with business, they are limited. Okay. The business does not have unlimited resources, which means that a business is always short of resources. Sometimes you are short of materials. Sometimes you are limited of labor. Sometimes you are limited in capital. So while using these limited resources, you need to maximize your profit or contribution. And I said that it is more about contribution maximization and not about profit maximization. Why do I say that? Because in short term, your fixed costs, they remain same. So in limiting factor analysis, our focus is that if I have material as my limiting factor, I should be using my material on producing those products which give me maximum contribution. So I rank different products according to their contribution. And then I say contribution per limiting factor. I'm not going to explain this topic here because there is a full lecture video available. I'm sure that you have watched that video. But the idea what to tell you is that here focus is on contribution maximization, because fixed cost, they remain same in the short run. Okay. So this is contribution maximization. This is your second topic from your decision-making section. Then you have third topic probably is, you have make or buy decisions, you have shutdown decisions, you have shadow pricing, and so on. And by the way, this multiple limiting factor, which you do it through linear programming, which is very important in your F5 syllabus. So I'm going to start with these two. Why do I pick up these two? Because the questions which are given in your practice kit, they are so mixed up. And sometime in one question, you are using the knowledge of the two topics. So we cannot, or we should not be separating the questions from these two topics. We should be handling them together. And I have picked up some questions. I will do those questions, and while doing the questions, if there is any revision of concept which is needed, we will do that as well. Some fundamental concepts we might be touching. So this is question number 88 from your practice kit. It says a business produces 3 products, Z1, Z2, and Z3. Each of these products require different amounts of material X. which is a scarce resource, which means a limited resource. So now it comes, limiting factor question. Now this is first you need to identify this is a limiting factor question and this is a single limiting factor question because only material X is a scarce resource. Like we say that in business, it is possible. I mean, theoretically, it is possible. In reality, not. Theoretically, it is possible that you have only one limiting factor, all other things are abundant. But in reality, nothing is abundant. In reality, you always have multiple limiting factors. Anyways, theoretically, we are seeing this question. The following budgeted data relates to the three products Z1, Z2, Z3, and they give you a lot of information: selling price, material, labor, variable overhead, fixed overhead, profit per unit. Always read these things, what information is given. Don't get absorbed into the numbers. Numbers do not matter. Only see what information is given. And then they ask you, match the products to the order in which they should be manufactured to ensure profit is maximized. Okay, we have to maximize the profit, so we cannot make everything because material is a limited resource and you have to make your choice. What should I produce first? Of course, you should be producing first, which is giving you maximum profit, for example. So they tell you profit per unit is 40, 35, and 30. But what do you do? You should be always making here your decision based on contribution. We say contribution per unit. These are two different things. Let me write down so that you do not forget. Contribution per unit. This is one idea. And contribution per limiting resource. This is a second idea. These are two different things. Contribution per limiting resource, per limiting resource factor. In our case, limiting resources material X, which is given in terms of kilograms. So I should be talking about contribution per kilogram. So I would say here, in this case, for example, contribution per kg. These are two different things. Always remember. Because it is possible. Let's suppose I give very short example to you. I gave that in one of the lecture videos as well. I make tables and I make chairs. Okay. When I make table, I get a contribution of $20. Okay. And when I make a chair, I make a contribution of $15. So apparently it looks like that tables, they give me more contribution. But then when you find out that the time taken on making one table is 2 hours and the time taken on making one chair is just 1 hour. So it means that contribution per hour, because my limiting resource is hours, I work 8 hours per day. So it means that every 1 hour I make, if I make tables, every 1 hour I earn $10 because I earn $20, but $20 also require 2 hours of effort. In case of chairs, although I am getting less, $15, but I can get $15 in every 1 hour. So it means that for me, making chairs is more beneficial because in any given one day, in an 8-hour day, how many tables I can make? I can only make 4 tables. But here I can make 8 chairs. So 4 tables multiplied by contribution 20. If I decide to start making tables, I can only make $80 in a day. 10 multiplied by 8, or maybe 4 tables multiplied by $20. But if I decide to make chairs, I can make $120 per day. In 8 hours, 8 chairs, every chair $15. So you should be very much clear that whenever you have to make a decision and there is a limiting factor a limiting factor comes in. If there is no limiting factor, I would be making tables. But I know that time is a limiting factor. I should be finding out contribution per limiting resource, contribution per limiting factor or scarce resource, and according to that, I make my ranking. So this is the idea you should be taking care of. Now, when you have here Z1, and then you have Z2, and you have Z3. So write down always what is the contribution and what is the time or limiting resource, how much limiting resource you are using, in this case number of kilograms, and then you find out contribution per limiting resource, and then you will do your ranking. Okay, this is, now I am again, because I'm explaining, so I'm writing it down. In exam you don't even write down, you do very quick, you know you have to save time to do it fast. Anyways, how much is the contribution from Z1? Who can tell me? Zaki, can you tell me how much is the contribution from Z1? How do you get contribution? Contribution is sales price minus variable cost. So 200 minus material cost 35 minus labor is 50, variable overheads are 45, and then fixed overhead I don't need. So my contribution is 70 here. Here my contribution is selling price 150 minus material 20 minus labor 25 minus variable overhead 45. And here it should be 100 minus 10 material, 10 labor, and 30 are the variable. So if you see that contribution is more in case of Z1. Z1 is giving me more contribution, but let's see how much material it is using. I'm not going to write down here. How much material are we using in Z1? Who can tell me? How much material are we using in Z1, please? Atik?
Sir, 7 units.
7 kilograms, right?
Yeah, 7 kilograms.
How did you find that 7 kilogram?
35 we use total and 5 per kg, so 35 divided by 5 because 7
Perfect. You have a total cost of $35, and it says that $5 per kilogram. So if it is $5 per kilogram and you are putting $35, it means that you are using 7 kilograms. So 7 kilogram is here. And how much is here for Z2? 4 and 2, right? 20 divided by 5 and then 10 divided by 5. And now you will find out your contribution per limiting factor. Now, if you see that this product Z3, which apparently was giving the minimum contribution, actually the contribution per kilogram is highest here. So this is your first choice. If you have to make a ranking, your first choice is here, and your second choice is this one, and your third choice is this one. Because you have to pick up a product which is giving you maximum contribution per kilogram. So material X is my scarce resource. I want to use material X in the most intelligent way. And most intelligent way is that use material X on making product Z3. Once your Z3 demand is completed, then you move to Z2. And then when you complete all of the Z2, then you start making Z1. It was a very short basic question, but a question which actually is a fundamental example of a limiting factor thing with single limiting factor question. Very basic question, but important one, because it will build up your further knowledge. This is question number 88. I can write down here. Okay. So now let's move further. We do to question number 89. It's a theoretical question. Everybody please read it quickly and then we will do answer. The following statements have been made about cost plus pricing. Now, what is cost plus pricing? Let me explain you. It's a traditional way of pricing your product. Cost plus pricing means that you incur all of your cost, and it is also sometimes called full cost plus pricing, and it is based on absorption costing method. You add your material cost, labor cost, variable overhead, and your fixed overhead. Whatever the cost comes, you don't care. Whatever the cost comes, you add your markup on the top of that. So you say that, whatever will be the cost, I need my 20% on the top. And by the way, cost plus pricing, I call it a traditional method. It has a lot of internal focus and you do not consider about your customers. You might be making a lot of wastage in your systems, and ultimately you want to recover that wastage from your customer. I am buying extra materials, I am paying more, I have more wastages, I am paying overtime, and then I say whatever it will cost me, I will add 20% on the top and take money from my customer. So it means that my customer is paying all of my inefficiencies. So therefore, it's a traditional method, it's an old method. It does not work in the modern business environment. It does not work in the competitive business environment. Cost plus pricing, whatever will be the cost, I will take it from customer along with my profit. So this is when you listen or when you hear about cost plus pricing, what should come to your mind? When I say target costing, what comes to your mind immediately is that you have set a selling price, and then you are trying to playing with the cost and minimizing the cost, decreasing the cost. So target pricing is a lot of customer focused, market focused. Cost plus pricing is opposite of that. You don't care about the market. What works here? The monopolies, the work like cost plus pricing. Government entities, public sector organizations, they work cost plus pricing. Whatever is the cost, recover it from customer, whatever it is. Anyways, the following statements have been made about cost plus pricing. A price in excess of full cost per unit will ensure that a company will cover all its cost and make a profit. So the following statements have been made. Which of the above statements is are true? So a price in excess of full cost. So you have full cost. What is inside full cost? Four cost: material, labor, variable overhead, and fixed overhead. So you say that my full cost, let's suppose, full cost means absorption cost. Okay. You say my full cost is $50, and then I put my markup, which is, let's suppose, 30%, and which is 15, and I put my selling price as $65. Okay. So it says that a price in excess of full cost, price which is 65, which is in excess of full cost 50, will ensure that the company will recover all its cost and make profit. Is it true or false? Is it true or false?
So true, I guess.
Why do you think it is true? It is false, because actually what we have added inside of full cost, you have only added production cost. You might have non-production cost. Maybe your non-production, how much markup you have added? $15. Maybe you have non-production costs which are $20. Then you are in loss, because you will make $15 markup, but then $20 you will pay to non-production. You will end up in making loss. So cost plus pricing does not ensure. So therefore, we say that because cost plus pricing does not include non-production also, it only makes sure that production cost will be recovered. Non-production, there is no guarantee. Therefore, this one is wrong. Second, it says cost plus pricing is an appropriate pricing strategy when jobs are carried out to the customer specifications. Yeah, this is true. So two only. It is appropriate when you carry out some jobs or orders on the request of a customer. Customer says, I want this product in this much design, or this is the design of the product, whatever. And then you can charge it to the customer because you are doing it according to the requirement of the customer. And then all of the cost customers should be bearing. So it is appropriate when jobs are carried out to customer specification, otherwise not. Okay, number 90. So 89, we answer is, we call it option number B, which is statement 2 is true. Okay. 90. Question number 90, a very simple question, but it makes your basic understanding of break-even thing. I think it is from break-even. Yeah, very interesting. Please read the question. I want to discuss, I want you people to contribute towards how to do this question, because this is where you will learn the approach, how to handle break-even questions. So I will give my solution in the end. I'm going to pause this recording and we are going to discuss this thing now. Okay, this is question number 90. Very simple question, but this is like fundamental for your understanding for break-even thing. They ask us question that each company uses a marginal cost plus pricing system, which means that variable cost plus. You say marginal cost plus. Here in the previous question, it said, full cost per unit will, yeah, it says cost plus pricing. When it says cost plus pricing, it means absorption cost, four components, full cost plus markup. Here it says in this question, it does not say full cost plus, it says marginal cost plus. So pricing is word separate. This is together. Marginal cost plus. Marginal cost plus means variable cost plus a certain percentage as a markup, and then you decide the price. To determine the selling price for one of its products, product X, the product X has the following cost: material 12, labor 5, variable overhead 3, fixed overheads 40. Fixed overheads are $20,000 for the year. Budgeted output and sales for the year are 500 units, and this should be sufficient for product X to break even. This should be sufficient. What profit markup would each company need to add to the marginal cost to allow each company to break even? So it means that their marginal cost is how much? Their marginal cost is equal to 12 plus 5 plus 3, which makes me 20. So marginal cost is 20. And they say what markup you should be adding, what profit, what markup, what percentage markup we should add up here so that we come to a selling price, which will make it a break even. Now, what usually we should be doing in this question, always remember that you should be thinking like, never think about fixed cost per unit. Okay, this is a very dangerous thing, because fixed overhead per unit, how did they calculate? It is based on your fixed overheads divided by your whatever output is there. Okay, so if your output goes up or your output goes down, your fixed overhead per unit will also go up or go down, but your total will remain same. So whenever you talk about fixed overhead things, always think about total fixed overhead. So always go with total fixed overhead. Otherwise, you will make mistake in exam, and you will also make mistake in real life. I have seen many management accountants making calculations and making budgets where they mess up with the budget by taking fixed overhead per unit. What does that mean? I tell you, let's suppose if I tell you, I'm not doing the question. Let me tell you, or let me show you why I say it is a dangerous error. If I tell you that your variable cost per unit is, say 20, like in this question, and I tell you that your fixed cost per unit is 40. Okay, and I say make a budget for 5,000 units, for 8,000 units, and for 10,000 units. This is where I have seen accountants in real life making mistakes. Okay, and I'm showing you that's why. So what they do, they say that, okay, if 5,000 is my this quantity, 8,000, 10,000, and I would say my total variable cost, and I would say my total fixed cost. And what do? They put here like 5,000 multiplied by variable cost is 20. Okay, and then 8,000 multiplied by variable cost is 20, and that is correct, that makes sense. 10,000 multiplied by 20. So the more variable cost you will incur, and that is true. It is okay. Okay, I have no problem with that. But then what he will do, he will say 5,000 multiplied by 40, and then he would say 8,000 multiplied by 40, And then you would say 10,000 multiplied by 40. Now that is false, okay? Because your fixed costs are not increasing. We said it is fixed cost, but it is not fixed here. So fixed cost, you should never do in your calculation per unit. Fixed cost, you should say my fixed cost is $20,000 or whatever. And then you just take it here and just copy paste it. Fixed cost never include into your per unit calculation. Am I clear now? This is how when you make your budgets, which of course is a topic of F5 as well, and in real life as well, fixed cost never go with quantities because quantities might change, but fixed cost will remain same until or unless there is a step up fixed cost where the fixed cost will increase. But fixed cost does not increase with every step of production. Anyways, it was just an example to show you so that you understand that I will never be focusing on this $40. I should be focusing on 20,000. So we would say that total fixed overhead is 20,000 and my production budgeted production is, I don't know how much, 500 units. It means that your budgeted fixed overhead per unit is going to be 20,000 divided by 500. So now in this case, it is, I mean, it is coming as 40 here and 40 here. So you could have said that, oh, I could have taken it straight away. Yes, in this case, by chance, it is same because you are using your 500. They also used 500. So answer is same. But there is a possibility that when you change the production, this might change. So therefore, it is better that don't take number from here, just ignore it and always go with the total. Because when you pick up the total, you are on the safe side. So now it means that break even is what? Break even means where your sales price is equal to total cost. Or you can call it, total revenue is equal to total cost, which is like sales price is equal to my variable cost plus my fixed cost. So my sales price should be, variable cost is 20 and fixed cost is 40. Therefore, my sales price should be 60. Now, if you are putting sales price 60, so what percentage? The question it said that what profit markup would be. So how much you are charging? You have a variable cost of 20 and you are selling the product for 60. So remaining inside $40 is what you must add as a markup. Okay, you must add as markup. So it means that your markup should be $40. If markup is $40, then percentage it should be 40 divided by 20 into 100, and which makes you 200%. The answer would be 200% for this question. Now, if you are in exam, this question you should be able to do it in less than a minute, just like Atik, he gave answer in less than 1 minute, because Atik did not do all of this thing. I did all of this thing just to give some well-rounded explanation. But if I'm in exam, I would, or probably you would do it in less than 1 minute only on calculator, that how much do I need to recover? You say, okay, $40 I need to recover. Total would be 60. 60 minus 20 divided by 20. So this is 40 by 20, or you can call it actually 60 minus 20. I mean, answer would be the same, okay? 60 minus 20 divided by 20 would give you 200%. This is the answer. Next is your question number 91. This is again about margin of safety, and margin of safety is your CVP analysis, break-even analysis. Now, what is margin of safety? I need to listen from you people. Somebody should explain me what is margin of safety. Why do we use it? How does it help us? Yes, please. Your time. Let's first discuss margin of safety. We call it MOS, okay? and you can put like this, MOS. So you have product A, product B, and product C. And here you've got margin of safety, which is given here as 15%. Here it is 22%. Here it is 17%. So what does it tell me? And which product I should choose, which product I should make? I mean, what is the message from this data? Who can tell me? I know how to calculate, it is very easy. But I just want to make sure that you guys understand the philosophy behind margin of safety. Why do we calculate it?
So we will select the product B, that is have the
You
maximum.
would put up product B. Why? Your answer is
Sir,
correct. Now
sir,
explain.
because margin of safety is higher over here, so like we have a more cushion of before going into loss.
Okay, yeah, exactly. So I would write it down as like this. I would say margin of safety is a safety cushion, like you use the word before you go into loss. This is margin of safety. For example, margin of safety is what? Margin of safety is, it is the difference between the budgeted sales and the break-even sales. Okay, let's suppose that your budgeted sales, you need your break-even sales are 100 units. You must sell 100 units to break even, which means no profit, no loss. Okay. And then you set up your target. Oh, I want to sell 110 units. Okay. So in this case, your margin of safety is like 10% approximately. So you have got a 10% margin of safety, which means that if your sales will drop down by 10%, you will go into loss. Now, that is a very, how to say, a small margin of safety. With an 11% decrease in the sales volume, you are making a loss. When I see that my margin of safety is 22%, I am kind of sitting relaxed. The sales team come in and they say, we are not meeting the targets. We might not be achieved to, we might not be able to achieve the budget. I say, okay, what is going to happen with sales? With what percentage are you going to make a shortfall? And he says, probably we will be missing the budget by 12% or even by 15%. I say, okay, no worry, because I know that although he should have met the budget, but even though he is missing the budget with 15%, I am still in the safe hands. I'm still not making a loss. So higher the margin of safety, the better it is. So margin of safety is that extra amount, it is that extra quantity which you put over and above your break-even sales, over and above your break-even sales. So this is the uh, idea or concept behind margin of safety. Now let's do this question number 91 very quickly. It says that the standard cost and revenues of log company is log company's only product are as follows. And by the way, margin of safety, it is a topic of CVP, and CVP has single product and break even and multi product break even. Okay, right now it says that only product, so it means that it is a single company break even. Multi product break even looks difficult, looks complex, but once you understand the logic, this also is easy. But of course, in the beginning it looks challenging. You just need to understand how to handle the multi product. This question is for single product. Sales price 60, material 12, labor 15, variable 3, fixed production 15, profit is 15. Fixed overheads are absorbed on budgeted production and sales of 10,000 units per year. So your fixed overheads, they put you here as $15 per unit, but they are based on 10,000 units. So when you multiply it, you can say that your fixed overheads per year actually are 150,000. Okay. I can understand this business. They have fixed overheads of 150,000 units. Based on 10,000 units output, they put 15 per unit. If this output changes, this number will also change. Sales staff receive a sales commission of 5% of sales volume. They take 5% from here straight. Okay, that's a very huge thing. What is logs margin of safety to the nearest hole? By the way, I'm going away from the question. I'm going away from the question. I will just tell you something from real life. When you are giving, okay, just stop your mind for 3 minutes from the question. I'll tell you something else. 5% of sales revenue is very, 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 very huge. I, in my personal opinion, generally do not give this thing. 5% of sales revenue means what? If you have a sales revenue of 100, he will get $5. Okay. When you, in normal businesses, when you have 100, very good businesses, they end up making net profit after tax, 20%. If you are making 20% after tax profit, you are a good company. I mean, that's a good investment. In small businesses, you might be making more, but in reasonable sized businesses, 20% after tax profit is good. So it means that the overall company is making 20% profit. This guy is taking 5. So out of 100, I take 20, you take 5. It looks like that he's taking actually, one fourth of my profit almost. He looks like my partner. He does not look like my employee. He's a 25% partner. Actually, it's a huge thing. And therefore, in many businesses, when you give bonus or incentive as a percentage of sales revenue, we don't give more than 2 or 3%, except for services. In services, yes, it is possible, but in products, that is amazing. Anyways, just one comment from the real life. So now what is log company margin of safety? So what you need to do now, you have to find out first that how much is your break even sales, how much are your budgeted sales, and the difference between these two is going to be your margin of safety. So who is going to help me in this question? 3 minutes you have, start working your mind, take out some calculations, and you guys are going to help me out with this question. Okay, let's start doing it. So first, so we know that margin of safety, to calculate margin of safety, we need these two things, okay? Budgeted sales and break-even sales. So let's first see how do we calculate break-even sales. Break-even sales formula is total fixed cost divided by contribution per unit. Okay, so fixed cost should be taken as total and contribution should be taken as per unit. So what is my total fixed cost? If you remember that I discussed before, that total fixed cost here would be fixed cost per unit, which is based on 10,000 units. So it means that total fixed cost will be 15 multiplied by 10,000. And it means that my total fixed costs are 150,000. And then what is my contribution per unit? Okay. How to calculate contribution per unit? Contribution per unit is sales price minus variable cost. So how much is the sales price? That is 60 minus variable cost material is 12 minus labor is 15 minus variable overhead is 3. And then there is one more thing which you should not ignore. It says that sales commission of 5% on sales revenue, which means every time somebody will sell $60 thing, they will get 5% of that. 60 times 5 is 3. So $3 you are giving actually. So you should subtract another minus 3. If you will ignore, your answer will be wrong. So you should subtract that sales commission as well. So now you have fixed cost 15,000, $27 is contribution, and I can say that my break even point is 15,000 divided by 27, which is 555.55, you have to round up because these are units. So it should be 5556 units. This is your break even point. And what is your budgeted sales? Your budgeted sales volume you have set as 10,000 units. Now, you know that your break even is 5,000, budgeted is 10,000. And here comes your margin of safety formula. Margin of safety formula, it says budgeted sales minus, okay, let me put it in brackets so that we do not ignore, budgeted sales minus break even sales, and close the bracket, and divided by, you have to divide it by your budgeted sales. So it means that I should be doing like this, 10,000 minus 5556 divided by 10,000. So this is going to give you the answer.
So I think your formula is incorrect. It's 150,000 by 27.
This is the formula for break even. Break even point formula is fixed cost divided by contribution per unit. Fixed cost total, contribution per unit. So my fixed cost is 15,000 and contribution is 20,000. Sorry, 150,000 is fixed cost. So this is the formula you need to remember. Break even point. Let me call it break even point. In lecture, I call it BEP. Break even point, or I call it BEP. Now, just one question here. So 44% should be the answer, which is option C. So you have got a margin of safety, which is 44%. Now, if I ask you, now question is finished. Okay, we have done. Just one quick question. What is your break even revenue? Can you tell me what is your break even revenue now? Break even revenue, the formula is break even point multiplied by selling price.
Sales.
So you have break even point as 5556 multiplied by selling price, which is 60 in this question. So I have got my break even revenue is 333,000. So sorry, like this, $333,000. Now, what does it tell? It says, now we have concluded answer was 44%. Let me but tell you what is the scenario. The scenario is that I need to sell 5,556 units to break even, where no profit, no loss. But I am planning to sell 10,000 units, well above my break even. If I sell 55556 in terms of units, my revenue should be 3,360. This is called my break even revenue. If my sales team comes and tell me that they are going to make sales of 310,000, it means that we will be making a loss. So I am looking at my target that minimum I should be making $333,000 in sales, or I should be selling 5,556 in units in order to break even. So what are my budgeted sales? So this is called my break-even sales, okay? Break-even revenue. What is your budgeted revenue? Your budgeted revenue is 10,000 units multiplied by 60 per unit, okay? So this is another number. I'm just playing around with some numbers. So it looks like that I'm just doing it extra work, okay? That I have given my sales team that you have to make or generate a revenue of 600,000. And I know that out of 600,000, 333 is my break-even point. Remaining is my profit. Remaining is my profit, the difference between these two. Until here, all cost will be covered. Variable cost will be covered within 333, fixed cost will be covered within 333, and the difference between these two goes into my pocket. Of course, I have to pay taxes. Okay, so that's the understanding. Anyways, this was number 91.